as well. Micheal Every, Head of Markets Research Asia Pacific at Rabobank, now joins us on the line from Hong Kong. Micheal, hi, good morning. What's worrying you more? What's happening in US or what's happening in Europe? What's worrying investors more about the emerging markets?
Well, I think Europe has been a long-standing worry. We haven't had any new developments there, so I don't see there's any particular reason for the sell-off today stemming specifically from Europe. Much more of it's led by a reaction to what we saw in US equities yesterday after we got better than expected US economic data. And I think this really underlines the bizarre new normal that we're in, that we get better economic data out of the US and the equity market sells off. We get worse economic data out of the US and the equity market rallies. If that doesn't tell you that something very strange is happening, then nothing does.
Michael, hi, good morning. That's an interesting point. But what did you make of the comments coming in from the US Fed Reserve, where Stanley Fischer said that a rate hike may trigger a lot of global volatility? Do you see a move away from risky assets like equities into treasuries in the near term? And would you expect to see a rate hike, the first rate hike from the Fed sooner rather than later?
Well, let me start with the second part of the question. Our house view remains that we won't see the first rate hike until December, and that's if the data continues to remain good. We've seen a very soft patch in the US economy recently. Yes, we had some good numbers yesterday, but overall I think it's still the later part of the year before we see the Fed actually do anything. Now, let's go back to the comment about volatility. To be honest, again, it's a no-brainer. Yes, if we do start seeing rate hikes in the Fed, from the Fed, yes, we will see volatility in equity markets, we'll see volatility in treasury markets too, we'll see volatility in FX markets. There won't be any area of the markets that's untouched by that volatility, which is exactly the reason why that they're waiting until the last possible moment to do so in our books.
Okay, Michael, specifically on India and the kind of pressure that we have seen on the currency market, do you think there's a risk that the Indian currency breaks the previous low and maybe the Indian equity market also tests the previous low?
Well, I mean, it's always a possibility of every outcome. I have to say that while we have definitely seen selling pressure in India recently, I keep reiterating that overall the fundamentals are still fairly positive. Yes, we want to see further momentum towards economic reforms. Yes, globally we're seeing a lot of headlines saying, okay, we're 1 year into Modinomics now. When do we actually really start to get some traction? And that's obviously seeing some people then decide to lock in some profits against the background of rising global volatility and worries about US interest rates. But overall, if you look at the growth picture in India, it's still pretty good. India is still going to be growing more rapidly than the US, however you measure it going forward. And I fail to see why equity investors wouldn't be able to differentiate between a long-term positive growth story there and a market that's being only supported by ultra-low interest rates in the US. I'm surprised that they can't see the difference.
Okay, one expert yesterday was indicating that the theory now is that current account surplus countries, the likes of Taiwan, etc., will continue to see fund inflows versus current account deficit countries like India losing out on inflows purely because once the rate hike comes, then, there will be a currency move on the downside for many markets like India. Would you buy that argument? And in terms of the pecking order of investing into equities now, what are your top preferences?
Well, again, let's look at the current account issue. Obviously, if you have a large current account deficit, that's a negative fundamentally for any particular currency. But what's important is also the change. If you're running a 5% deficit this year and last year you had a 6% and before that a 7%, I think the market can actually say, hey, you're moving in the right direction. And it doesn't make any difference that you're running a deficit. At least they can see you're improving. The same thing for countries running a surplus. If you're running a larger surplus but it's declining, I think the market's more likely to be nervous rather than reassured. So it's directionality rather than the outright level of where a current account is that is of some importance when you suddenly get into a more volatile market when there's a concern about liquidity. In terms of actual equity picks, I'm afraid I don't make specific calls. I look at the bigger picture rather than the individual companies.
My only question was, will we lose out to other markets like China in the due course of time? Because we have seen a huge outperformance of the Chinese markets versus India.
Well, I think over time, depending on your time frame, I remain positive on India for exactly the fundamental reasons I was just talking about. This is an economy that can grow quite comfortably at 7-8% in real terms, maybe 12% in nominal terms, 13% even, depending on inflation, for year after year after year going forward. In China, the absolute opposite is true. We already have slowing real growth, nominal growth which is declining quite precipitously, and major concerns about where growth will be a year, 2 years from now. Now, yes, Chinese equities are up 100% year to date if you're in Shenzhen and around 58% if you're in Shanghai, but I would be extremely nervous about how long this particular market can be sustained. It absolutely smacks of a bubble to me, and what goes up can very definitely come down. One should never forget that.
All right, so just before we let you go, Michael, just one final word, because we're seeing a bit of pressure in the global markets, especially in the US. Do you see more of a sell-off in risky assets like equities, in the next 2 to 3 months?
I think that very much depends on the data direction. If we continue to lean towards a Fed rate hike in the second half of the year, then I think there probably will be some people deciding to lock in profits, step back from equities a little bit, and maybe even just sit on cash for a while and wait and see what the market looks like when the dust settles. But it really does depend on the data picture going forward.
All right, Michael, thanks a lot for taking a call this morning and talking about the trade setup.